welcome to ForexTV.com's PM Exchange. It's Tuesday, July 28th, 2009. I'm Julie Sinha with your currency commentary. In data releases today, U.S. consumer confidence fell more than expected in July. Looking at price movement today, it seemed either investors brushed off the data or used it as confirmation to avoid the risk play. There is no question, though, that confidence data and disappointing earnings overshadow the fact that home prices rose on a monthly basis for the first time in 3 years. In the New York session, the dollar got a boost on the said-to-be negative confidence report as traders budged out of stocks. The dollar bounced back from its 2009 low. Traders also were said to be taking profits on short U.S. dollar positions. They were also saying that the U.S. dollar was recently oversold on all the hype about earnings. But let's hear what our guest has to say. Joining us to discuss this and other price action is market strategist Melvin Harris from Advanced Currency Markets. Melvin, thanks for being back here with us.
Thanks for having me.
So I'd love to get your opinion about the U.S. dollar bouncing off that low. If you think that investors really cared about the confidence report out today, or what we're looking at right now.
Well, I think the consumer confidence report is a major factor in terms of risk appetite. I don't hold a lot of credence behind these types of economic indicators. They're volatile at best. I think there's an undercurrent of risk aversion that's really driving the markets right now. Some of the valuations regarding corporate earnings are being taken with a grain of salt. Some of the expectations in regards to growth down the line, I think, is overshadowing a lot of the market action.
What about the general downtrend in commodities? What are your thoughts about that, and how closely should we be paying attention to any commodities in particular? Very
closely. I think the commodities market is a major example of some of the regulatory changes that we'll see in the overall financial markets. I think what's happening with oil, some of the discussions from the CFTC are having a heavy impact in terms of what people expect speculators to be able to do the next several months. In addition to that, the supply and demand story is really not there to really keep prices at current levels. Oil will have a very difficult time breaching $70 a barrel in the current state.
Yes, and today it was just under 68. So what were your thoughts about that? It looks like we could be trading in more of a range for oil throughout the summer, even though there's traditionally more demand in this season. What are your thoughts on that?
Yeah, range trading is probably the most pertinent phrase across asset classes, not just commodities. We're seeing that in FX. All the moves are very flat. It's hard to get excited, when you're seeing a 10 to 15 point move during the New York session. Some of the action overnight in the Asian session is a little bit more interesting, 100-point moves, but everything seems to retrace back come the open of the U.S. equity markets, and then the close even today in the stock markets is very light.
And it seems like, yes, today we did have a slight changes. Only NASDAQ was up. It's only by 11 points.
Exactly.
The other two indices down. It seems like you were saying, that oil is going to be range bound. But everything's driven by the earnings reports that we're seeing, equities, and that carries over to the other markets. So can we still do you think we should be looking at earnings as a main market driver?
I don't think we should look at them as a main market driver. We should look at them as a current market driver, information that's coming out as of now. I think more importantly, it's really to gauge some of the commentary coming from central banks. Bernanke came out over the weekend and made some very strong comments in support of the dollar, said they have a very strong dollar policy, and even though we're looking to generate growth here in the United States, he wants that to come from capital inflows back to the U.S. And I don't think he means that through treasuries per se, but that just gives you a picture of what things are to come.
Okay, and also let's talk about later this week. We have durable goods Wednesday, we have the second quarter GDP on Friday. Is there anything that your firm is looking at for guidance, or to confirm whether it's risk appetite or risk aversion?
Yeah, we're definitely looking at GDP. That's a central indicator for us, even though it's somewhat backwards looking, a little bit manipulated by the stimulus plan and everything else that's happening from a fiscal standpoint. But it is very important in terms of driving risk appetite, risk aversion. The numbers are already expected to be negative. If it deviates far out of what the mean is in terms of expectations, then we'll probably have an even larger move. But I don't think GDP or durable goods will be a make or break type of thing. We're very much in the summer doldrums. There's a lack of volume, yes, lack of direction,
lack of traders,
a lack of traders. Guys around the Hamptons right now. Really, it's a story of, can the volatility that exists really be enough to push markets, in excess of 200, 300 points? And I don't think we'll see that until September.
And there's a lot of talk too about money being still placed on the sidelines and people waiting to see where to put that in. How long do you expect that to continue?
Yeah, that is probably the single most important point to bring up in this conversation is the amount of capital on the sidelines, not just in China.
Yes.
A lot of banks are really on the sidelines, have a very conservative kind of approach to the market right now, with the exception of maybe a Goldman Sachs. I mean, once these players start to reinvest or get involved in the markets again, it will have a tremendous effect on the types of action we will see. I think to judge the market in the context of what we're seeing right now is a little bit unrealistic as opposed to what we'll see in 6 months from now.
Okay, thank you for that. You called that 6 months. We appreciate that.
No problem.
And going back to the range-bound trading and looking at advice for a lot of the short-term FX traders that we have, we keep hearing from a lot of commentators that come on the show. Just look for the short term, particularly in FX. Don't even worry about the medium term because there's more volatility in session to session. Do you agree with that, or would you say that that's a little bit too strict of guidelines?
Well, I think it depends what the profile of the person is. If you're an active trader, you probably should be a little bit more short-term.
Your blood pressure can take it, and you're sitting there in front of your with your own money.
That's one of the factors, exactly. If you're an investor, the medium term is definitely more suited. A more of a relative value approach, looking at what currencies may have higher or more beneficial factors behind it to be invested in. We talk a lot about trading, but no one really talks about investing. And I think that FX as an asset class is definitely more opportunistic for an investor as opposed to just actively trading it. You can do both.
Okay. And let's move on. You provided us with a couple of charts, so thank you for that.
Not a problem.
Like to focus on Euro-Yen.
Sure,
and
sure.
We're hearing some talk that there could be a medium-term rally, or there's some levels that we should be looking at. What do you see happening for the chart that you provided with us, and what's going to happen?
I picked the Euro-Yen today only because any of the yen crosses right now is a great barometer of risk appetite and risk aversion. I know the dollar yen is the common one everyone talks about, but some of the moves are a little bit more exaggerated. When you use a euro yen or an Aussie yen chart or a Kiwi yen chart, not really so much because of the interest rate differential, but just because of the bias in the marketplace. I think one of the key things to look at, just for the euro in particular, and I'm going to deviate away from euro yen and just talk about euro US dollar because everyone's brought up this point about 143 being a major level of resistance and falling back. People looking at it from a futures perspective and net long positions looking more bullish for the euro. I mean, all these are factors that should come into play in terms of trying to put together a strategy and capitalize on that position across the board. I mean, if we're seeing a breakout in the euro USD, fundamentally speaking, it's very likely we can see a breakout in the euro yen. I mean, because you have a very dynamic risk appetite, risk aversion comparison there.
Okay, and then also you mentioned that 143, around the 143
for euro USD.
For Euro USD, and there's a lot of talk too about that prompting wave of profit taking.
Yep.
How do you see that, or is that?
I think that's somewhat of a factor.
So we just need to call out. Is that more of like an analyst just saying, let's say that this level means something?
To be honest with you, there's a combination of some factors there. I mean, the main one is you have a consensus of people who say the same thing over and over again.
Need something to say. They have to
they have
write
to throw a
articles
number
every
out
day.
there. You can find 10 articles that say 143, and yes, if you've been watching it very actively, it's hit 143 and bounced back. Do I think it's profit taking? I don't think there's enough volume for there to be profit taking, to be honest with you.
That's across the board.
Yeah, I mean, I think it's just we don't have enough momentum to push beyond 143. I think the technical signals call for a break of 143, and eventually we'll get there, but we need a little bit more hard momentum to break through that level. I don't think it's profit-taking, though.
Okay, and if we could just wrap it up, we're almost at midweek. What do you see as something that's important for traders and investors to look out for? Whether it's, we got to mention fixed income because you're one of our fixed income guys, definitely. One of the major ones, actually, as a commentator. What markets should we be looking at to wrap up this week? Anything interesting?
We should definitely bring up the auction, $115 billion. That actually, I can't believe that auction went off well. Only because it seemed a little bit more of external demand than just the Fed coming in and trying to buy back debt and so forth.
It seems like a lot of traders are waiting the outcome for the whole week.
Yeah, it's very symbolic. The fact that yields were able to stay above certain levels, 2-year above 1%, 10-year approaching about 3.75%, and the 30-year well above 4%. I mean, this is very important in terms of looking at the yield curve and gauging what the behavior will be in the interest rate markets going down the line. And also some of the commentary about from Bernanke saying that he will be looking to raise rates at some point to counter inflation. These are huge dollar supportive factors. If we can have auctions and debt financing without a total blowout in rates, then we need to move away from that idea that rates and stocks are completely inverse. I mean, in that situation, bond prices were falling and so were stocks on Monday. I mean, so you really have to look at things very carefully, and I think it goes into that story about correlations and being able to analyze new relationships in the market.
Okay, Melvin, thank you so much for being here.
Thank you for
and
having
your opinions.
me. Thank you.
That was Melvin Harris from Advanced Currency Markets, and that does it for PM Exchange. If you want to learn more about Melvin and interact with him and other Forex TV guests, go to www.forextvconnect.com and start interacting with our trading community. I'm Julie Sinha. Join us later for more news right here on forextv.com.